Many traders search for the best Forex strategy or try to understand how professional traders read the market. But without a clear understanding of market structure, liquidity, and how price movements develop, most strategies eventually fail. Hello traders, and welcome to the Com Lucro channel. In this video, we will walk through a market structure masterclass for beginners, using the Euro-Dollar Forex pair as a real chart study. Through top-down analysis and multi-timeframe concepts, we will study how professional traders read the market structure, how the optimal trading zone, fair value gaps, and order blocks appear inside price movements, and how these elements help traders understand where high-probability movements may begin in the Forex market. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Before we begin the chart study, a quick note about the annotations you will see on the chart. The letters used in the labels indicate the time frame and the state of the structural event. The letter W refers to the weekly structure, and the letter D refers to the daily structure. You may also see the letter P, which indicates a possible structural event that has not yet been confirmed, and the letter F, which indicates a failed structural event. The numbers that appear in the annotations are simply used to organize the sequence of movements and make it easier to follow the development of the structure on the chart. Feel free to pause the video for a few seconds so you can clearly understand how the labels work before we continue with the chart study. Now, let's begin. The first important reference in the structure is the level labeled Weekly Low 1. This point represents the exhaustion of the previous bearish market phase, where selling pressure begins to weaken. From this low, price starts an expansion phase that marks the beginning of a new structural development in the market. During this expansion, price produces the event labeled Weekly Change of Character 1. This is the first confirmed signal that the previous bearish control has been broken. In other words, the market shifts from a bearish structure toward the beginning of a bullish structure. This entire move from Weekly Low 1 up to Weekly High 2 forms the first impulse movement. It establishes the foundation for the new bullish environment. After this first expansion, price begins a correction. This retracement forms Weekly Higher Low 3. Corrections like this play an important role in market structure. They help rebalance inefficiencies created during the impulse, generate liquidity in the market, and prepare the conditions for the next expansion. Once the correction is complete, price begins the next impulse movement. During this expansion, price breaks the previous swing high at Weekly High 2, confirming Weekly Break of Structure 2 and finishing with Weekly Higher High 4. This break of structure is significant because it confirms the continuation of the bullish trend. It also validates the higher low created during the previous correction, showing that buyers are maintaining control of the market. After this second impulse, price once again enters a retracement phase. This correction produces Weekly Higher Low 5. Similar to the previous correction, this movement helps mitigate prior imbalances and prepares the conditions for the next expansion. From this higher low, price expands again in what becomes the third impulse movement. During this expansion, price breaks the previous structural high and confirms Weekly Break of Structure 4. As this impulse continues, price produces a new higher high labeled Weekly Higher High 6. This new high reinforces the bullish sequence of higher highs and higher lows that defines the current market structure. Several important structural events occur throughout this development. The first is Weekly Change of Character 1. This event marks the transition from the previous bearish structure into the beginning of a bullish structure. Next, we see Weekly Break of Structure 2. This event confirms that the market is no longer simply reversing. Instead, it is now forming a clear bullish trend. Later in the structure, Weekly Break of Structure 4 occurs during the impulse expansion from Weekly Higher Low 5. This event confirms that the bullish trend remains active and that the sequence of higher highs and higher lows continues. Each of these events helps confirm the structural narrative of the market. The most recent completed impulse is the movement that expands from weekly higher low 5 up to weekly higher high 6. Because of this, the current trading range of the market is defined by these two levels. The lower boundary of the range is weekly higher low 5. The upper boundary of the range is weekly higher high 6. Price is currently trading inside this range, while the market develops the next correction phase. Understanding this range is important because it defines the key structural decision area for the market. From this point, two structural possibilities exist. The first scenario occurs if price breaks above weekly higher high 6. In that case, the market would confirm weekly possible break of structure 6. This would represent the continuation of the bullish structure and the beginning of a new impulse expansion. The second scenario occurs if price breaks below weekly higher low 5. In this case, the market would confirm weekly possible change of character 5. This event would signal that the current bullish structure may be transitioning toward a bearish environment. These possibilities are not predictions. They simply describe how the structure could evolve depending on which key level the market breaks. At the moment, the structural bias of the market remains bullish. The sequence of higher highs and higher lows is still intact, and the most recent impulse created a new higher high at weekly higher high 6. Price is currently in a correction phase within this bullish structure. As long as weekly higher low 5 holds, the bullish structure remains valid. It is also important to understand how different time frames work together when studying market structure. The higher time frame helps us understand the overall direction and structural context of the market. However, traders typically do not look for precise entries directly on the higher time frame. Instead, once the higher time frame structure is understood, traders usually move to a lower time frame to study how price behaves inside that larger structure. For example, if we analyze the weekly structure, entries are often studied on the daily chart or even on the 4-hour chart. With that in mind, we can now move from the weekly perspective down to the daily chart. Now, when we shift from the weekly perspective down to the daily chart, something very interesting becomes visible. The structural levels between these two timeframes begin to align with each other. In other words, the weekly structure and the daily structure are interacting at the same price levels. For example, the level labeled weekly higher low 5 corresponds to the same price point as daily higher low 3. This means the lower boundary of the weekly trading range is also the lower boundary of the daily trading range. In other words, the weekly range defined by weekly higher low 5 and weekly higher high 6 is mirrored on the daily structure by daily higher low 3 and daily higher high 4. This alignment helps us understand how the lower time frame structure develops inside the larger weekly context. Starting from the beginning of the daily structure, the first reference point is daily low 1. This level marks the exhaustion of the previous bearish movement on the daily time frame. From this low, price expands upward and produces daily high 2. This movement represents the first impulse of the developing bullish structure on the daily chart. After this first expansion, price enters a correction phase. During this retracement, the market forms daily higher low 3. This correction performs the typical role of a retracement within the structure. It helps rebalance inefficiencies created during the impulse, generates liquidity in the market, and prepares the conditions for the next expansion. The formation of daily higher low 3 confirms that bullish control remains intact after the initial expansion. From this higher low, price begins the next impulse movement. During this expansion, price breaks the previous high at daily high 2. This expansion produces a new higher high labeled daily higher high 4. At the same time, the market confirms daily break of structure 3. This break of structure validates the continuation of the bullish market structure and confirms that the higher low at daily higher low 3 is structurally protected. This impulse represents the most recent completed expansion on the daily chart. After reaching daily higher high 4, price enters another retracement phase. This correction is currently unfolding within the daily trading range. During this retracement, price begins interacting with mitigation areas that were created during the previous impulse. One of these areas is the zone labeled daily fair value gap 3. This imbalance was generated during the impulse that produced the break of structure. price is also interacting with the bullish zone labeled Daily Order Block 3. This area represents the origin of the impulse that created Daily Break of Structure 3. Because both the Daily Fair Value Gap 3 and the Daily Order Block 3 belong to the impulse that created the break of structure, they naturally become mitigation targets during the retracement phase. At the moment, the most recent completed impulse on the daily structure is the movement from Daily Higher Low 3 to Daily Higher High 4. Because of this, the active trading range on the daily chart is defined by these two levels. The lower boundary of the range is Daily Higher Low 3, which also corresponds to Weekly Higher Low 5. The upper boundary of the range is Daily Higher High 4. Price is currently retracing inside this range while interacting with mitigation zones created during the impulse. From a structural perspective, two possible outcomes exist. If price breaks above Daily Higher High 4, the market would confirm Daily Possible Break of Structure 4. This would represent the continuation of the bullish structure and the start of a new impulse. On the other hand, if price breaks below Daily Higher Low 3, the market would confirm Daily Possible Change of Character 3. This event would signal that the current bullish structure could transition toward a bearish structure. For now, the structure on the daily time frame remains bullish. The sequence of higher lows and higher highs is still intact, and the current retracement is unfolding within the trading range established by the last impulse. As long as Daily Higher Low 3 holds, the bullish structural bias remains valid. It is also important to understand how traders often approach execution when working with multiple time frames. In this case, both the weekly structure and the daily structure are currently bullish. This means the market is aligned across these two time frames, and the directional bias remains to the upside. When this type of alignment exists, traders often avoid chasing the expansion phase. Instead, they study how price behaves during retracements within the bullish structure. In these situations, attention often shifts to what many traders call the optimal trading zone of the impulse movement. This zone represents the portion of the retracement where price begins to rebalance the previous expansion. When price retraces into this area, traders may move to an even lower time frame to observe how price interacts with structural elements that were created during the impulse. These elements can include structures such as a fair value gap or an order block that originated during the expansion. If price retraces into the optimal trading zone and begins interacting with these structures, traders may then observe whether the lower time frame begins to transition back into bullish structure. In this type of study, the entry is often positioned near the beginning of the fair value gap created during the last impulse on the daily chart. The protective stop is typically placed near the origin of the expansion movement, where the impulse initially began. The objective of the movement, when studying the structure in this way, often aligns with the end of the expansion phase of the higher time frame impulse. In this case, the target area corresponds to the upper boundary of the weekly impulse movement, which is aligned with the daily structure we have just analyzed. This type of positioning allows the trade to be structured with a favorable risk-reward profile. In this example, approximately 1 to 2.85. As observed in this chart study, the objective of the movement was eventually reached, resulting in a strong and profitable trade within the broader bullish structure. In other words, the higher time frame provides the directional context. The retracement defines the area of interest, and the lower time frame reveals how price structure begins to transition back into the direction of the broader trend. To conclude this chart study, we analyze the market using the weekly and daily charts because higher time frames usually provide a clearer and more reliable view of the overall market structure. By understanding the larger structure first, traders can identify the broader directional context before focusing on possible execution opportunities. However, the concepts discussed in this video are not limited to these specific timeframes. The same structural principles can be applied across different trading styles. For example, a trader studying the weekly structure may look for entries on the daily or even the 4-hour chart, where the lower time frame reveals the detailed price behavior inside the higher time frame context. The same idea also applies to lower time frame trading. A trader might analyze the 60-minute chart for context, then move to the 15-minute chart for potential setups, and if necessary, go even lower to the 5-minute or 1-minute chart to observe how price structure develops and identify possible entries. Please also remember that the mission of the Calm Lucro channel is simple. Our focus is to help traders develop clarity, confidence, and structure, so every decision in the market is made with discipline and clear intention. On this channel, you will find complete courses designed as a true trading masterclass. We teach the liquidity concept in trading, the complete guide of market structure, higher time frame analysis, and supply and demand trading strategy principles, always focused on understanding price behavior and executing with a professional mindset. We also explore trading psychology, risk management, and long-term consistency, because trading is not only about charts, it is about mindset, discipline, and structured execution over time. There are no shortcuts in the markets. Real progress comes from continuous study, observation, and practice. Our main courses include smart money concepts, ICT concepts, technical analysis for day traders, trading psychology, and the Wyckoff method course. Alongside these courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Francis Hunt, and Mark Douglas, whose work has helped traders better understand the structure of financial markets. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are also working on how to become a successful trader. Make sure to subscribe and turn on notifications so you do not miss our latest trading psychology masterclass lessons and deeper insights about the markets. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? Or what topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the Calm Lucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.